Wall Street hates this undervalued stock, and today I want to talk you through why Wall Street hates this business, what happened, and what happens next. Welcome back to the Value Investor Show. Today I will reveal a stock that in my opinion is very undervalued. If you remember, in my last video I talked through 4 stocks that I believe are massively undervalued, and I left cliffhanger for you guys to guess the 5th stock. That's the one I will deep dive into today. I'll walk you through the market price, the business overview, the financials, the intrinsic value, and a bear, bull case and base case, as well as my next steps moving forward with this business. As always, thank you so much for the support. It really goes beyond words. I'm now at 2,400 subscribers, but in fact only 26% of you watching my videos are actually subscribed. So if just 1 in 5 of you subscribed right now, I would be able to reach my 3,000 goal by the end of the week. So if you're new here, if you're not subscribed, just hit that button below. I spend so much time and effort putting those videos together for free for you guys. And so your support truly means a lot and motivates me to produce more content. Now, as I said in my last video last week, there is a warning. A lot of billionaires, a lot of economic analysts are warning that the stock market is overvalued. We have been on a roll over the past 3 to 4 months, and since April, the stock market has been performing fantastically. And what I explained in that video, which you should check out if you haven't already, is that historically the S&P 500 has seen months of 4 to 5% corrections every 4 to 5 months. In our case, over the last 4 months, we have been on an upward roll. So many analysts argue that maybe now is the time for a correction, that in the next few months, we'll see some downward pressure. Even the fear to greed index is now at a neutral stage for the first time in a while. It has been at the grid for the longest time, and that shift tells us that we should keep an eye on whether the market keeps pushing upward or if there's a correction just around the corner. And in this environment with fewer opportunities available, I think that this stock that I will reveal today is particularly undervalued. The company that I want to reveal today is PayPal. Over the last year, PayPal is down 13% and is now trading at a P/E ratio of 14. I'm sure everyone knows PayPal as a company. In fact, Elon Musk helped found it 20 or 30 years ago, but not everyone knows how PayPal actually makes money, as well as what is PayPal and what is the bear case of PayPal. So PayPal's business is primarily based on transactions. So that means that the more transactions are processed through PayPal, the more money they make. The business benefits from powerful network effects, and each additional consumer or merchant provides more value for all participants all worldwide. Globally, the company processes 26 billion transactions annually, which is an insane number to think about. And on top of that, they generate $73 in annual revenue per active account while maintaining very high customer satisfaction and retention rates that shows efficiency and stickiness in their model, in their product. But despite this strength, the stock has been driven downward. There has been fear around the integrity of the business, concerns over the growth, and that's what we will dive into later in this video. The history of PayPal is very straightforward. Historically, PayPal has been driven by a shift from in-person and cash payments to electronic payments, online payments, the rise of e-commerce, Amazon, mobile e-commerce, eBay, and many more websites. They also benefited temporarily from a huge surge in e-commerce during the COVID-19 pandemic, which really accelerated their revenues, but those tailwinds reversed. PayPal hit headwinds. New competition like Klarna began to eat into market share. As a result, the management attempted to combat this pressure with a greater focus on cost control, product innovation, and therefore margin improvements. Their aim was to create a more sustainable and more profitable growth future path. However, it's now clear that it will take way more time for those results to truly show up on the bottom line. And one more thing to consider is that PayPal is heavily influenced by the broader economy. If the macro picture changes, if it turns negative, if disposable incomes shrink, we could see a spending decline, which would swamp improvements in PayPal's fundamentals, at least in the near term. From a metric standpoint, this is a complete no-brainer. The PE ratio of the company is 14, the price to book ratio is 3.3. There is double-digit historical growth both in revenue, EPS, as well as free cash flow. The company has 10 billion in cash and very low debt levels with a quick ratio of 1.27. So while PayPal has undeniable strengths, not only in their business model, but also in financials, it really faces very real challenges. And that's why Wall Street hates it right now, but that's why it might be exactly undervalued. And for this video, I will dive exactly on what is going well with the company and what is actually driving this bearish movement. So if we look at the financials, in the next 2 years, PayPal will reach 37 billion in revenue and 5.8 billion in net profit. The company will trade at a forward plus 2 PE ratio of 11. 11, that's an insanely low PE ratio for a company that is still growing. And also keep in mind that this has been a very consistent company. PayPal has consistently improved both their top line and bottom line over the last decade, and they will continue to do so, albeit at a slower pace. In terms of earnings yield, PayPal is trading close to the most attractive valuation to date, but free cash flow remains laggard. The free cash flow yield is lower than what it has been before, and we'll exactly dive into why this is happening. Even though the net income is increasing, the revenues are increasing, the free cash flow over the last year has seen a drastic drop. So free cash flow dropped in 2025, down 42% year over year because of adverse timing in their working capital, but they are expected to balance out later this year. So that means in Q3 and Q4 of 2025, we are expected to see much higher growth in free cash flow, which should balance out that sharp drop in the first 2 quarters. But the lower valuation has led to a huge surge in buybacks. The company has been buying buybacks very heavily, especially more so in the last 2-3 years when they have been spending $6-7 billion per year on buybacks with a buyback yield of almost 10%. The management sees that this stock is now undervalued and they're buying back heavily. They're trying to buy back their stock as much as they can, especially given the opportunity. Now, one thing to flag, although the company is buying back heavily, insiders are yet to buy the stock, but rather they're selling, which does raise some questions in my perspective, because if the company is undervalued, why are insiders still selling that stock? The red dots over here are sales of the stock, insider sales of the stock. And as you can see, most of the insiders are actually selling rather than buying. In terms of market share, PayPal has 45% of the market share in the digital payment processing business, but it faces increased competition in things like buy now, pay later from companies like Klarna, and they also face competition from the digital wallet adoption, which is heavily driven by Apple Pay. There's also Google Pay, which is now growing much faster, but fundamentally, PayPal is facing increased competition from different segments. In fact, PayPal as well yesterday announced that it's transforming its AI-centric shopping queries into seamless buying experiences by adding new capabilities to PayPal Honey. And they released this picture which kind of looks like OpenAI, although my suspicion is that this is on the back of the announcement that Shopify is partnering with OpenAI so merchants can sell directly from ChatGPT. Essentially, what will happen in the next few years is that all these LLMs will allow you to buy directly from their platform. You will say, for example, I'm looking for headphones. They'll give you the top recommendations and you wouldn't need to open another web page. It would allow you to buy directly from your chat with the LLM. So the bear case is very simple. The separation between online and point of sale transactions is blurring, and PayPal may increasingly come into more competition with larger companies in the future, as companies like Klarna, Apple Pay, Google Pay, and many others are increasingly gaining enormous market share in the online payments industry. Another bear case is that a few governments could favor local players. For example, in China, Alipay and WeChat provide solid examples of how PayPal could be shut down out of emerging market opportunities, as well as the bear case suggests that opportunities to monetize Venmo could be very limited moving forward. Now, the bull case or the catalyst of the business are a completely different point of view. The first point is that the scalable nature of the business could allow PayPal to improve its margins over time, and this is something that we have noticed as well over the last 1-2 years, maybe not to the extent that the management was, but there's still a lot more potential for management to reach 20% net income from the current 15 to 16%. Also, PayPal's long-running experience in online payments is a unique asset that is becoming more valuable as e-commerce becomes a bigger piece in the pie. Essentially, PayPal's experience in the online payments industry allows them to scale fast and use their network to offer new product offerings in their vast amount of existing customers. The third bullet point is what I have been talking about before, which is the Google AI catalyst. PayPal and Google said they're partnering to create a new shopping experience online with artificial intelligence. And as part of that multi-year tie-up, Google will embed PayPal across its platforms, and PayPal will use Google's AI to enhance its e-commerce services. So PayPal is leveraging Google's AI to create new experiences, and potentially they could see a collaboration between Gemini and PayPal, which would prove to be very valuable in further increasing the number of transactions for PayPal. Also, PayPal has recently added a buy now, pay later and fast checkout innovation, which could allow PayPal to gain more market share in some market segments that maybe other companies leading. But this is an example of where PayPal is already using their network, is already using their tech capabilities to enter new offerings that could be given to the already vast amount of consumers they have. Now, let's dive into my 3 cases in terms of intrinsic valuation for the company. In my base case, I assume a 4% revenue growth, an 8% net income growth, and a 9% free cash flow growth. This is in line with expectations. And essentially what I'm saying here is that by 2030, the net income, the profit margin of the business will reach 19%, which I think is fair. I think it's the base case of this company. So while the company in the base case is not growing massively in revenue, they're able to massively improve their bottom margins, their net income, and free cash flow growth. And under those assumptions, my intrinsic value for the business with the DCF method is $150, which gives a margin of safety of 53%. Now, with the EPS method, simply because I've also used a PE ratio of 16, which I think is fair given it's a 3-year average, the intrinsic value of the business is $78. So that doesn't give enough margin of safety, in my opinion, given that my margin of safety is 50% to enter this company. Now, for my bear case scenario, I have assumed 2% revenue growth, 4% net income growth, and 4% free cash flow growth. So under this scenario, by 2030, the profit margin would only increase to 17% from the current 15%, which I think is still a fair assumption even at the bear case scenario. And revenue top line growth is essentially very minimal. It stagnates completely as maybe competitors gain market share, as PayPal isn't able to scale their new offerings and is increasingly losing more market share. So under those assumptions, my intrinsic value in the bear case is $120, which surprisingly, it still gives a 41 margin of safety. So even at the bear case scenario, the DCF method assumes or predicts that the company is still undervalued. Although with the EPS method, the intrinsic value of the business is $64, which gives essentially a negative margin of safety, which means it's under the current price. The bear case is still a probable scenario in my opinion, but it's less probable than the base case and the bull case. Now, if we go through the bull case scenario, in my bull case scenario, I assume that the new offerings of the business are booming. the company is able to capitalize on their technology. They start gaining market share in some market segments. And even though they're not growing at the historical revenue growth, they still managed to grow at 7% year on year with very big net income growth and free cash flow growth of 13%. And under that assumption, my profit margin comes to roughly 20 to 21%, which I think is a fair estimate for a bull case scenario. And under my bull case scenario with the DCF method, my intrinsic value is $177. And with the EPS method, again, using a P ratio of 16.7, which is the 3-year average, my intrinsic value with the EPS method is $98. So that gives me 30% margin of safety with the EPS method and 60% margin of safety with the DCF method. So in a case of a bull case scenario, I think that the company is massively undervalued and I see a lot of upside with PayPal. Now the question begs, what am I doing with this stock? If this stock is fundamentally way undervalued, what am I doing with it? Well, I'm not currently invested in PayPal. I'm not yet convinced that PayPal has an edge, especially given the race competition. There's so many companies in Europe, in the US, that are entering the digital wallet and the buy now, pay later segment. And I'm just not convinced that PayPal, although it's huge, could have an edge in this segment. Also, I'm a bit skeptical in case there are any issues with the economy in the next 1 year, we could see less spending, but I will study the company further in the coming weeks. And I might enter if I think that the opportunity, the risk reward upside is just something that I cannot ignore. But I'm curious to hear more about you guys. Are you buying PayPal? What are you thinking about the stock and the business itself? Leave your comments down below and I'll catch you in the next one.